What's your take on the hedge fund industry trying to move in to some extent to the retail market? We see groups such as the Man Group and others trying to pitch a hedge fund product for individual investors. Do you think they have a room in at least in the Canadian marketplace?
I have money with a few hedge fund managers. They're people I know well and trust, and I'm willing to pay them their egregious fees to try and make some money for me. But I think hedge funds working into the broader sort of retail market is for sure a disaster. It is the only way you can really make it more palatable and less volatile and less risky, is to really diversify. And some of the providers have done that. They've selected a whole bunch of different hedge fund managers, packaged it all together. But what that brings then is it brings more index-like returns at probably 2 or 3% plus 20 or 30 by the time you get the packaging. So all of you, I think you've got to appreciate, think about the return environment we're in. I hope you all do better than this, but we're in a 3 to 4% interest rate world. So the bond part of your portfolio is probably going to earn 3 or 4%. That's a very good predictor of bond returns, is just what the existing yields are. So we could spend another meeting on this, but what's the premium on, what's the equity premium over bonds?
Could you provide just more color about which kind of debit problem you expect in short term, medium term, long term?
I'm not sure what the reference is, but there's, I'll make 2 comments about debt. One is, obviously we have too much debt in the world, and I said everything's cyclical. Don't be very skeptical of somebody telling you it's a secular trend. So here I'm about to tell you there's a secular trend, and that is obviously deleveraging, which is going to drag out over many, many years. The governments have to deleverage. We know about the U.S. consumer, and European consumer isn't as bad. Canadian consumer isn't as bad, but so there's this deleveraging impact. Not to say we can't all make a ton of money through that process, but that will slow things down. It'll make there'll be bumps in the road like Greece and Portugal and obviously before that the banks. But so I there's just so much debt there. I think we have to be very wary of that. And I'm not a market timer, but we've tried to dial our clients' portfolios down a bit. Example, if somebody's 50-50 bonds, equities, and a nice balanced portfolio, we're probably 40 to 45 equities, and it's because of this debt overhang and all the issues that come with that. The other thing I'd say about debt is let's remember as investors that, and most of you I think are equity investors, but we've had this huge tailwind since 1981, and it's called declining interest rates. I had if we had a chart in there we could have used, but just before I got in the business, rates were, and some of you know the story, some of you were there, mortgages at 19% and all the rest, and we've had this huge tailwind. And that is just a powerful tailwind behind bonds, obviously, but also stocks. Valuations back when those rates were up high, nobody was going to pay much for a dollar of earnings, so you could buy IBM, I don't know about IBM, but J&J or Pfizer or some of these things at 7, 8 times earnings. I mean, you'd kill for those valuations today, but they were, those earnings weren't as valuable when you had inflation at those high rates and you had and the opportunity in the bond market. Anyway, where are we today? Well, if you think about, as an investor, we all focus on the end point. What did it get my return? What's the multiple now? But as investors, we want to think about what's the starting point. And so our starting point now is rock bottom interest rates. And I'm not that bearish on rates. I don't think they're going through the roof. I don't think we have enough inflation, and we've got other issues. But we have lost that tailwind likely, and so valuations will go up, ebb and flow. But we probably have a bias towards valuations coming down over time if rates do tick up. So I think that's the interesting thing about debt is how are we going to pay for, how are we going to finance all this debt? Real issue for sure. But I think we'll work through that. And but I think the bigger issue is, as investors in general, is just being wary of maybe having a little bit of a headwind as opposed to a tailwind.
Well, you mentioned inflation. there are really two school of thoughts right now about inflation. You have the deflation school talking about a lot of slack in the economy, possibly the deleveraging, and you have the inflation school talking about the quantitative easing, the low interest rates. Where do you stand on that, and based on your scenario, how would you position your portfolio based on your inflation or deflation outlook?
I'm exactly on the fence.
So how would you position your portfolio?
I'll tell you why I'm on the fence on that too. I'll tell you why, because I think I've got reasonably good instincts over that 27 years. I've had lots of great mentors to teach me. And my instincts say that when you're ramming liquidity into the system like we've been doing for the last few years to keep things going, there's inflation coming. And it's just, I'm not an economist, but that's kind of how it works. And when the world's awash with money, asset prices, and there's inflation. So there's that side of the argument which just will always be there in my head. But the other side, and Larry Lund from Connor Clark and Lund has articulated it really well for our clients, there's just so much capacity, loose capacity in the world, whether it's labor. If you need people, there might be certain segments of the economy where there's a shortage, but there's a lot of labor out there in Europe and in U.S. and in Asia, and so there's, we just don't see labor inflation. There's a lot of unused capacity out there in the world, and if it isn't in North America, you'll find it in China. It's hard to sort of see where the inflationary pressures are coming, and that's really what's got me on the fence. What am I doing? I'm sitting on the fence as far as how I run a portfolio. I want to have obviously some resources and some inflation-sensitive kind of things, but I'm not. I'm staying fairly short on bonds and owning corporates instead of long bonds, that sort of thing. So it's. As Mark Twain said, I don't have a risk of feeling I'm absolutely sure about something. In fact, I'm writing a column for the Globe, or drafting one up, and it'll probably allude to the fact that I'm as confused as I've ever been. And I don't think that's a bad thing as an investor. I mean, there's lots of things I'm not confused about, certain stocks I want to own, but I don't have a big, a real defined view right now like I did a year and a half ago.
Well, great. Well, I wish that we had more time, but we're already running way behind schedule. Thank you very much for your time, and hopefully we'll have you again in the future.
Okay.
Thank you.
Sure. Thank you.